You open an ad invoice and there's a mysterious new charge, digital services tax. Your App Store payouts shrink in a few countries while everything else looks normal. You didn't tweak bids. You didn't break the funnel. So what's eating your margin? Digital services tax, the tool governments use to tax digital revenue linked to their own users. Instead of waiting for old profit-based rules to catch up, they're taxing the cash flow right where the views, clicks, and purchases happen. How exactly does it work? Imagine your cousin has a lemonade stand on wheels. He parks on different streets. On one street, lots of thirsty people buy his lemonade, but he doesn't have a kitchen there or a big shop, just his cart. The neighborhood says, if our people drink his lemonade here, we want a tiny sip of his money. That sip is DST. A DST is a charge on gross revenue. Gross means before costs, that a business earns from certain digital services used by people in a given country. It works for targeted advertising, online marketplaces, social networks, search engines, and app stores, and sometimes the monetization of user data, and usually applies only to big groups measured at the consolidated level, so small firms are filtered out by high global revenue thresholds. It is not VAT, and it is not corporate income tax. It doesn't wait for a permanent establishment or for local profits to appear on a tax return. It attaches to where the users are and skims a few percent off in-scope revenue, like 2 to 7.5. If you're wondering whether a few percent really matters, hold that thought until we run your marketplace margin through a DST blender. Why did countries invent this in the first place? Traditional corporate tax allocates profits to places where companies have people and offices and servers. Digital models earn huge revenue from countries full of users but maintain a very small physical footprint there. The international community has been negotiating a long-term fix known as the OECD's Pillar One, which would reallocate a piece of residual profit to the markets where users live. It's a big project and needs coordination to go live. Governments wanted a stopgap that worked now, so they introduced DSTs to claim a slice linked to their user bases immediately. Pillar 2, the separate 15% minimum tax, is about effective rates on profits and lives in a different lane. Even if Pillar 2 is running, it doesn't replace DST, because one looks at profits and the other looks at user-linked revenue. And just when you think, okay, who actually uses this? We step onto the map where your costs begin to diverge by country. France charges 3% on certain digital revenues from French users if your group is big enough. The United Kingdom takes 2% on revenues from search, social, and marketplaces tied to UK users once you cross both UK and global thresholds. Spain collects 3% on intermediation, digital ads, and user data monetization linked to Spanish users, with quarterly filings that keep finance teams caffeinated. Italy sits at 3% and broadened inclusion by leaning on global thresholds, pulling more groups into scope. Turkey cranks the dial to 7.5% on a wide digital base, which makes ad brokering and intermediation margins feel very small very fast. India's equalisation levy looks different on paper. 2% on non-resident e-commerce operators and a legacy 6% on certain ads, but behaves a lot like a DST in practice. Some countries have proposed and paused measures under trade pressure or while waiting on Pillar 1. Others actively operate their regimes and update them. Here's the hook you didn't want. Even in places without a local DST, platforms sometimes adjust pricing because internal routing, attribution, or neighboring rates shift the economics of certain flows. You might not see a DST law in your country, but you can still feel the ripple in your invoice. How do platforms decide which country claims which slice? They follow the users. For advertising, the relevant location is where the ad is viewed, not where the advertiser sits. For marketplaces, it's the buyer's location at the moment of transaction. For social networks, it's the user's account country inferred from device and profile signals. For app stores, it's the purchaser's country, as determined by account and billing data. These signals already live in product systems for payments, content rules, and fraud control. DST turns them into tax-grade evidence. That means data pipelines must be audit-ready and reconciled to invoices and cash, with analytics, billing, and tax calculations singing from the same song sheet. I heard your question. If the platform is the one with the legal bill, why do you, the advertiser or developer or seller, feel poorer? How do platforms decide which country claims which slice? They follow the users. For advertising, the relevant location is where the ad is viewed, not where the advertiser sits. For marketplaces, it's the buyer's location at the moment of transaction. For social networks, it's the user's account country inferred from device and profile signals. For app stores, it's the purchaser's country, as determined by account and billing data. These signals already live in product systems for payments, content rules, and fraud control. DST turns them into tax-grade evidence. That means data pipelines must be audit-ready and reconciled to invoices and cash, with analytics, billing, and tax calculations singing from the same song sheet. I heard your question. If the platform is the one with the legal bill, why do you, the advertiser or developer or seller, feel poorer? Economists call the answer incidence. The law says the platform owes the tax, but the platform runs a marketplace, or an ad engine, or an app store with millions of counterparties. When a small gross tax slices into a thin margin line, there isn't much cushion. The platform passes most of the cost along. Advertisers see higher CPM or CPC, or they see a line called DST on their invoice. Sellers see higher platform fees in affected countries. Developers notice territory-specific proceeds change. That subscription in France or the UK lands differently in your bank after DST and store tiers. And yes, consumers can end up paying a little more when sellers or developers adjust retail prices to keep margins intact. If that feels unfair, think back to the lemonade cart. If the street takes a sip, you either swallow the hit, nudge the price, or get smarter at selling more cups. Which takes us to you. What happens roll by roll? And how do you react without turning your spreadsheets into spaghetti? As an advertiser, you most often meet DST as higher platform prices in certain countries or as a clearly labeled surcharge. Your first move is to get more efficient with the same spend. Tighten audiences, lean into higher intent cohorts, and refresh creative to protect click-through and conversion rates. If even good creative can't outrun the tax bump, you reweight budgets toward countries and channels with better after-tax payback and hold your ROAS and CPA thresholds at country level, so blended dashboards don't hide a problem market. As a marketplace seller, you'll see platform fees rise in DST geographies. That means rebuilding contribution margins by country and asking whether you can raise prices without killing velocity, pruning low-margin SKUs that fall below threshold, and redeploying inventory to countries where after-fee economics still clear your bar. As a developer, you'll get territory-specific changes to App Store proceeds. The play is to localize pricing, sweeten perceived value around increases, nudge annual plans that stabilize retention, and watch LTV by territory so your user acquisition targets don't drift. Agencies and growth teams add a DST column to media plans and monitor payback at the country level because averages are where margins go to disappear. That's the day-to-day. Under the hood, the platforms you rely on are doing their own calculus. Think about Google first. Search and video are the core exposure, with display, programmatic, and app distribution riding along. Google attributes billable events to user markets and then raises prices or applies surcharges where laws kick in. You experience that as higher effective, CPM or CPC, and respond by tightening targeting, refreshing creative, and, if necessary, migrating budgets to alternative geographies or channels. Meta behaves similarly. Facebook, Instagram, and Audience Network are squarely in scope because they sell targeted ads to local users. Meta hardens its user location logic for impressions and applies geo-specific pricing. Performance advertisers feel the change quickly. Audiences get narrower, creative cycles get faster, and spend leans into places with better after-tax payback. Apple's App Store is a different angle. Revenue is inherently territorial because it follows the purchaser's country. Under DST, Apple adjusts price tiers or developer proceeds by territory to preserve its own margins. If you run subscriptions, you recalculate LTV and churn, pair price changes with value upgrades, push annual plans, and treat each territory as its own P&L. Amazon faces DST in two lines at once: marketplace intermediation and advertising. Expect higher seller fees or country surcharges and recalibrated ad pricing. Third-party sellers respond by raising prices where competition allows, cutting low-margin SKUs, and shifting stock toward geographies with healthier after-fee margins. Microsoft's LinkedIn sits in the social/B2B lane with geo-specific billing and user location logic. B2B teams protect cost per lead by focusing on intent and adjusting bids by territory. Smaller ad-heavy platforms like Snap, TikTok, and X display the same pattern: segmented pricing by geography and cost pass-through, followed by advertisers reshuffling spend. DST turns global products into local puzzles, which forces pricing and product design to change shape. In Instead of one universal price for ads, marketplace fees, or developer proceeds, platforms move to country-specific tables. Features that have low strategic value but thin margins may be deprioritized in high-rate DST markets. Product managers build DST into decisions about where to launch first and which promotions make sense after tax. Finance teams stop treating DST like a random thunderstorm and start baking it into gross-to-net waterfalls so forecasts don't keep getting surprised. Here's the next cliffhanger. None of this works if your user location data is messy. When a regulator calls, "We think that ad was viewed in Spain," is not an argument. It's a shrug. To calculate DST properly, systems need to know where a user was when an ad was viewed, where a buyer sat when they clicked pay, and which country a purchaser's account belongs to in App Store transactions. Those facts must match across analytics, billing, tax calculations, and the audit trail. Privacy rules still apply, so the data architecture separates personal details from the aggregate signals needed to compute DST while preserving mappings that stand up in audits. Internal controls document how you collect, transform, and aggregate data, how the numbers reconcile to invoices and bank statements, and who signs off. If you ignore this, you risk paying too little and facing penalties, or paying too much because the safest assumption in a messy file is rarely the cheapest. Will these taxes disappear if a global deal finally lands? If Pillar One's multilateral convention actually enters into force across the big players, many governments that adopted DSTs have promised to roll them back or narrow them. Making that promise real will require avoiding double counting, setting effective dates cleanly, and dealing with relief for overlapping periods. If Pillar One remains stalled, DST regimes will persist and may expand. Some countries could raise rates, widen definitions, or lower thresholds to rope in more groups. Others might pause to dampen trade friction. Meanwhile, Pillar 2 continues independently because it addresses profit-based effective tax rates rather than user-linked revenue. You cannot plan on DSTs vanishing next quarter. You need two playbooks, one for a world where Pillar 1 replaces DST and one where DSTs are part of the furniture. So what should you actually do on Monday morning? If you buy ads, bake DST into your planning at the country level. Track effective CPM and CPC with and without the DST component so you see the real change rather than guessing. Protect your ROAS thresholds by moving spend across geographies and channels, not just between ad sets in the same country. Measure incrementality at the country level so a blended dashboard doesn't hide that one market got pricier while its neighbor did not. Update your contract so pass-through is explicit, not a surprise footnote. If you sell on marketplaces, rebuild contribution margins by country to reflect new fee schedules and DST pass-through, segment your assortment so fragile SKUs don't sink your average, and explore alternative channels, other marketplaces with different fee structures, or direct-to-consumer routes where you control pricing. If you develop apps, maintain a territory proceeds model that combines DST, exchange rates, and store tier changes. When you adjust prices, communicate plainly. Bundle improvements that make the change feel fair, and promote annual plans or value bundles that stabilize retention. Monitor LTV by territory and adjust your user acquisition bids accordingly. On the platform side, tax and finance teams should maintain a live scoping matrix per country that lists in-scope services, thresholds at the consolidated group level, and filing cadence. Verify thresholds annually, because crossing the mid-year can flip obligations, and monitor official releases and platform bulletins for scope or rate changes. Engineering and data teams should implement user location controls with testable checkpoints, then ensure billing either shows DST explicitly or embeds it cleanly with clear explanations. Zoom out, and the strategic shift becomes obvious. DST pushes companies to think in country-level profit and loss, not just global averages. Product teams choose market entry and feature timing using after-tax economics rather than generic CAC and LTV. Commercial teams negotiate pass-through and price flexibility, so new taxes don't trap everyone in the wrong margin. Legal teams keep clauses updated so tax changes can be implemented without renegotiating the base deal. Over time, geo-specific pricing and fee structures stop being special cases and become standard practice. That's not a bug, it's the new operating system. And here's your final cliffhanger. If Pillar One finally lands, you'll need to unwind some of this logic without breaking your models. If it doesn't, you need to run this playbook confidently quarter after quarter. Either way, you win by being ready.